Breaking, silver explodes to 106.55. What just occurred? Sunday evening. Most traders had closed their screens. Retail investors were nowhere near their terminals. And then it happened, 106.55, not during regular hours, not with warning, not gradually, in minutes. The question isn't just what happened. The question is what broke. And more importantly, what does this violent price dislocation reveal about the structures holding our financial system together? Because when a market moves like this in the darkness of off-hours trading, it's not sending a signal. It's sending a warning. Welcome to Financial Rewind. If you've made it this far in life, built something, stewarded capital through multiple market cycles, then you understand that the most dangerous financial moments rarely announce themselves with fanfare. Do me a favor, would you? Hit that subscribe button below, not for entertainment, but because informed decision-making requires access to analysis that doesn't insult your intelligence. And drop a comment. Let me know where you're watching this from. London, Singapore, New York, São Paulo. Because what we're about to examining affects every market, everywhere. Let's begin. Most people were not watching. It was Sunday evening. The traditional trading floors in New York and Chicago were dark. The big institutional desks were running on skeleton crews, retail traders. The kind who check their portfolios obsessively during market hours were nowhere near their screens. And that is precisely when it happened. At 6 p.m. Eastern Time, the Globex electronic trading platform opened for its overnight session. Globex is the CME Group's after-hours marketplace. It runs nearly 24 hours a day. It is where foreign institutional buyers operate. It is where algorithmic trading systems execute orders when American traders sleep. Within minutes of the open, silver futures contracts spiked to $106.55 per ounce. Not gradually, not over hours, in minutes. Traders monitoring live feeds watched in real time as the price chart went nearly vertical. Some called it a gap and run scenario. Others used more colorful language. But everyone watching understood one fundamental truth. This was not normal price action. To understand why this matters, one must first understand what Globex represents. During regular trading hours, the silver market has depth. There are market makers providing liquidity. There are commercial hedgers on both sides of trades. There are thousands of participants creating what traders call orderly markets. But after hours, liquidity thins dramatically. When liquidity is thin, prices should not explode higher. They should drift. They should consolidate. Large moves in thin markets typically happen downward, when panic sellers hit bids and no one is there to catch the falling knife. Upward explosions in thin markets tell a different story entirely. They tell observers that someone needed exposure immediately, that a buyer or multiple buyers showed up with urgency and size, that this entity or these entities were willing to pay significantly above the previous price to secure their position. And they were willing to do this when hardly anyone else was watching. This is not speculative behavior. Speculators wait for liquidity. They spread their orders. They try to minimize market impact. This was something else. Now, silver is unique among traded commodities. The vast majority of silver futures contracts are paper agreements. Traders buy and sell contracts with no intention of ever taking physical delivery. They are betting on price movements. They close positions before expiry. They roll contracts forward. But a small percentage of contracts do go to delivery. And for those contracts, the exchange must have physical metal available in its registered vaults. This is where the technical picture becomes crucial. Over the past 18 months, registered silver inventories at the COMEX, the primary futures exchange for precious metals in the United States, have hovered near historical lows. Registered means available for delivery against futures contracts. Meanwhile, open interest, the total number of outstanding contracts, has remained elevated. In simple terms, there are more claims on silver than there is silver readily available to deliver. For months, precious metals analysts have been pointing to this imbalance. They have shown data. They have warned about potential supply squeezes. Most mainstream financial media ignored these warnings. And then came Sunday evening when the price exploded on Globex. It did something that pure paper speculation cannot explain. It revealed that somewhere in the global financial system, there is stress between what silver is supposed to cost and what someone is willing to pay to actually get it. Consider the evidence beyond the futures market. Physical silver coins and bars have been trading at premiums of 4 to 6 over the spot price for months. Some products even higher. Dealers report difficulty sourcing material. National mints are running weeks or months behind on orders. Refineries cannot keep pace with demand. If silver were truly abundant, if supply were meeting demand comfortably, these conditions would not exist, yet they do. And now, in the middle of a Sunday night session, when most of the world was not paying attention, the futures price jumped violently. This is not entertainment. This is not drama for social media clicks. This is a market sending a signal that something fundamental has changed. The question serious analysts must now ask is simple. What structural forces caused this dislocation? And what comes next? There's a number that mining executives do not like to discuss in public: 13,000 tons. That is the approximate annual deficit between how much silver the world mines and how much silver the world consumes every single year for the past 3 consecutive years. Think about what that means. Imagine a reservoir that feeds a city. Now imagine that reservoir loses more water each year than rainfall can replenish. At first, no one notices. The reservoir is large. There are decades of accumulated water. But year after year, the water line drops. Eventually, someone looks down and realizes the buffer is gone. That is where the silver market stands today. The mining industry has a problem it cannot easily solve. Silver deposits are not infinite, and the easy ones, the high-grade deposits near the surface, were discovered and extracted decades ago. Today's silver miners face a harsh reality. Ore grades are declining almost everywhere. What this means in practical terms is simple. Miners must move more rock, process more material, consume more energy to extract the same amount of silver they got 10 years ago. And it gets worse. Roughly 70% of newly mined silver does not come from primary silver mines. It comes as a byproduct. When companies mine copper, lead, or zinc, silver often appears in the same ore body. These miners extract the silver because it is there, but their primary business is the base metal. This creates a strange dynamic. Even if silver prices rise dramatically, many mining companies cannot simply increase silver production. They are mining for copper. The silver is secondary. If copper demand softens, silver production falls, regardless of what silver prices do. This breaks the normal supply response mechanism that exists in most commodity markets. Meanwhile, on the demand side, and something unprecedented is happening, the world decided to go green. Solar panels require silver. Require. Each photovoltaic panel uses approximately 20 grams of silver in its conductive paste. There is no commercial substitute that matches silver's efficiency at the necessary scale. In 2020, the solar industry consumed roughly 100 million ounces of silver. By 2023, that number had grown to over 150 million ounces, and the trajectory is not slowing. China alone is installing solar capacity at rates that would have seemed impossible 5 years ago. Europe is accelerating. India is ramping up. The United States is subsidizing domestic solar manufacturing. Every single panel needs silver. Then there's the electric vehicle revolution. EVs use more silver than internal combustion vehicles, much more. The electrical systems, the battery management circuits, the charging infrastructure, all consume silver. A typical EV uses between 25 and 50 grams of silver. Some estimates go higher, depending on the model and features. Global EV production is projected to grow from roughly 10 million units in 2022 to over 30 million units by 2027. Do the math. That is hundreds of millions of additional ounces of annual demand that did not exist a decade ago. And then there is 5G. The infrastructure build-out for fifth-generation wireless networks requires silver in ways that previous generations did not. The density of equipment, the number of cell sites, the specialized components, all of it adds incremental demand. But here is what makes the situation truly structural rather than cyclical. Military and defense applications are accelerating. Modern weapon systems, missile guidance electronics, radar arrays, communication equipment, naval vessels, all consume silver. And in an increasingly unstable geopolitical environment, defense spending is rising globally. Medical applications continue growing. Silver's antibacterial properties make it irreplaceable in certain healthcare products. Wound dressings, surgical instruments, coatings for medical devices. Every single one of these demand sectors is growing. Not might grow, is growing right now, with multi-year trajectories that show no signs of reversal. And on the other side of the equation, global mine production has been essentially flat for 5 years. The buffer stocks that used to absorb this imbalance, the above-ground inventories held by governments and exchanges and industrial users, have been systematically drawn down. This is not a temporary supply disruption. This is not a labor strike at one mine or a political crisis in one country. This is a fundamental mismatch between geological reality and industrial necessity, and it has been building for years. The Sunday evening price explosion was not the beginning of the story. It was the moment the market started to recognize that the story has been unfolding all along. In March 2020, the United States Federal Reserve created more dollars in 3 months than it had created in the previous 100 years combined. Read that sentence again. 100 years of monetary expansion compressed into 90 days. The European Central Bank did the same. The Bank of Japan followed. The Bank of England joined. Central banks across the developed world opened the floodgates simultaneously. They called it emergency liquidity provision. Economists called it quantitative easing. But there's a simpler term that captures what actually happened. Dilution. When a company issues new shares, existing shareholders get diluted. Their percentage ownership decreases. The same principle applies to currency. When central banks create trillions of new monetary units, every existing unit becomes worth less. Not worthless, worth less. And the people who understand this distinction, the treasury managers at multinational corporations, the family offices managing generational wealth, the sovereign wealth funds managing national reserves, they began moving, quietly at first. Then with increasing urgency, central banks themselves started buying, not their own currencies, physical gold. In 2022, central banks purchased over 1,000 metric tons of gold. In 2023, they purchased even more. This was not routine portfolio rebalancing. This was active accumulation at levels not seen in decades. But here's what most analysts missed. Gold gets the headlines. Gold has the history. Gold is what central bankers talk about in official statements. Silver is what they are actually concerned about. Why? Because gold is purely monetary. It has minimal industrial use. Its value comes almost entirely from its role as a store of value and reserve asset. Silver is different. Silver has the monetary history, the thousands of years of use as money, but it also has the industrial necessity. It is required for the technologies that governments say they must build for national security and economic competitiveness. This creates a dual demand dynamic that gold does not face, and sophisticated allocators recognize this. There is a ratio that precious metals traders watch obsessively, the gold to silver ratio. It measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, over centuries, this ratio has averaged somewhere between 15 and 30 to 1. Sometimes it goes higher during periods of financial stress when gold outperforms. Sometimes it compresses when industrial demand surges. In recent years, the ratio has been trading in the 60 to 80 range. What this means in practical terms is simple. Silver is historically cheap relative to gold, and yet silver has all the monetary characteristics of gold, plus the industrial demand that gold lacks. Smart money sees this asymmetry. But there's a deeper shift happening beneath the surface of markets. The international monetary system is fragmenting. For decades, the US dollar has been the undisputed global reserve currency, oil traded in dollars, international debt issued in dollars, central bank reserves held in dollars. That system is eroding, not collapsing, eroding. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create alternative payment systems. They are settling trade in their own currencies. They are discussing a commodity-backed settlement currency. And what commodity keeps appearing in these discussions? Gold and silver. Russia has been accumulating. China has been accumulating. Even smaller nations that historically held only dollars and euros are diversifying into precious metals. Why? Because they watched what happened when Western nations froze Russian central bank reserves after the Ukraine invasion. They saw that currency reserves held in another nation's banking system are not truly reserves. They are permissions that can be revoked. Physical metal in your own vault cannot be frozen by someone else's political decision. This is not conspiracy theory. This is stated policy from multiple finance ministers. The trust that underpinned the post-World War II monetary order is breaking down. And when trust breaks down, people return to things that do not require trust, things that cannot be printed, things that cannot be debased, things that exist independent of any government's promise. For 5,000 years, that has meant precious metals. The banking sector understands this better than most people realize. The pension funds managing retirement savings for millions see the demographic math. Too many retirees, too few workers, too much debt, too little growth. The promises made cannot be kept at current purchasing power. So the sophisticated money is moving into assets that do not depend on promises. And on that Sunday evening when silver spiked to 106.55, the market was not just pricing in supply and demand, it was pricing in the slow collapse of monetary certainty. There's a question that separates experienced capital allocators from everyone else, not what happened, but what does this mean for tomorrow? The Sunday evening price spike is history, the structural deficit is documented, the monetary deterioration is measurable. Now comes the harder part. Strategic response. Business leaders face a calculation that did not exist in previous decades. Their operating environment now includes a commodity that is simultaneously becoming scarcer and more essential. Silver is not optional for the technologies that define competitive advantage. It is not a nice-to-have input that can be substituted away. And the price discovery mechanism just sent a signal that the old assumptions no longer hold. So what should serious decision makers be thinking about? First, scenario planning requires honesty about base cases versus tail risks. The base case is straightforward. The structural deficit continues. Mine production stays relatively flat. Industrial demand grows at current trajectories. Above-ground inventories continue declining. Price volatility increases. Periodic supply squeezes create temporary spikes followed by corrections. In this scenario, silver trends higher over a multi-year time frame, but not in a straight line. There will be pullbacks. There will be periods of consolidation. Patience and strategic positioning matter more than timing perfection. The bull case is more dramatic. Acceleration happens. Either industrial demand surges beyond current projections, or monetary crisis forces institutional capital into hard assets, or major supply disruption removes significant production from the market. In this scenario, price moves become nonlinear. The kind of overnight gap seen on Sunday becomes routine rather than exceptional. Physical premiums over paper prices widen dramatically. Delivery delays extend from weeks to months. The bear case deserves consideration as well. Demand destruction is always possible. If a global recession hits hard enough, industrial consumption could fall. If technological breakthroughs create viable substitutes, silver's necessity diminishes. If massive new deposits are discovered and brought online quickly, supply constraints ease. Honest analysis requires examining all scenarios, but it also requires assessing probabilities. Which scenario seems most likely given observable facts? The demand drivers are not speculative. Solar installations are happening. EV production is ramping. 5G infrastructure is being built. Defense spending is rising. These are committed expenditures with multi-year timelines and political backing. The supply constraints are geological. Declining ore grades are measurable. The lack of new major discoveries is documented. The 7 to 10 year timeline from discovery to production is reality. For manufacturing companies that depend on silver inputs, this creates a strategic imperative. Procurement strategies designed for commodity abundance no longer make sense. Just-in-time inventory management carries new risks. Spot market exposure creates unpredictable cost structures. Forward-thinking operations teams are reassessing long-term supply contracts, strategic inventory buffers, vertical integration into supply chains. These options carry costs today, but provide insurance against disruptions tomorrow. For financial portfolios, silver presents an unusual profile. It offers inflation protection like other commodities. It provides monetary hedge characteristics like gold, but it also captures industrial growth in ways that pure monetary metals do not. Position sizing matters enormously. Silver's volatility is higher than gold, much higher. Allocations must account for this. A position that feels comfortable during calm markets can become psychologically unbearable during volatile periods. Physical versus paper exposure requires careful thought. Futures contracts provide leverage and liquidity, but they are claims on metal, not metal itself. Exchange-traded funds offer convenience, but introduce counterparty risk. Physical coins and bars eliminate counterparty risk, but create storage and insurance costs. There is no universally correct answer. The right structure depends on individual circumstances, risk tolerance, and liquidity needs. But there is a universally incorrect approach, ignoring the signal entirely. The broader economic implication extends beyond silver itself. When a commodity that is essential to modern technology demonstrates this kind of price behavior, it suggests that the era of abundant cheap resources is ending. Energy, rare earths, copper, lithium, the entire complex of materials required for the energy transition all face similar dynamics. Growing demand, constrained supply, years of underinvestment in productive capacity, geopolitical fragmentation of supply chains. Silver is not unique. It is early. The strategic lesson is not buy silver. The strategic lesson is reassess assumptions about resource availability. For 3 decades, globalization meant prices trended down, competition increased, supply chains optimized for cost, abundance was assumed. That era is over. The new era requires different thinking. Resilience over efficiency, security of supply over lowest cost, strategic reserves over just-in-time delivery. The Sunday evening price spike was not an isolated event in an isolated market. It was a preview of the repricing that happens when the world realizes that what it needs is no longer easily available at yesterday's prices. Wise capital allocators are not asking whether this matters. They are asking how to position for what comes next.